Morning, everyone. Thanks for tuning in. Today we have two companies that we'll be touching on. First is Chip Eng Seng and Hobby Land. Both are developers. So without further ado, let's jump into Chip Eng Seng. Okay, for the benefit for those who don't know who Chip Eng Seng is, it's actually a company that first started in as a subcontractor in the 1960s and slowly built itself up to become a HDB contractor, building HDB projects. So iconic ones are like I'm sure most of you have seen it, is Pinnacle and Duxton, and eventually it was listed on SGX main board in 1999. Back then, it was first listed as a main contractor and property developer. Today, it has four business segments in real estate development, construction, hospitality, and property investment. Okay, next, we will just briefly summarize what happened in 2015. Earnings declined 77.6% to $63 million, and this was mainly because there were lesser projects to be recognized as bulk of the revenue from launch projects have already been recognized in the previous year. Construction segment booked in lower revenue because of lesser active projects during the year. And the new segment in hospitality contributed $14.1 million during the year. We'll explore further in a few slides. Rental income was up to $10.8 million because of maiden contribution from CES Center, which started operating in the first quarter of 2015. Now we'll explore each of the segments in detail. We'll look at the property development in Singapore first. There was the High Park Residences, which was launched in July 2015, saw very good sales. Up to now, 94% of it are sold, despite the weak property market. And based on our estimates, we think that development margin should come in around the 24% territory. And this means that the group will be able to book a development profit of around $160.9 million over the next few years until TOP is obtained. That will be sometime in 2020. So solidly, you should see something like $32 million coming to the company. They are looking to relaunch this high-end development in Fort Road. It's a freehold development, and it was first launched in 2012, but because of weak sales, it was taken offline. So this year, the group is planning to relaunch the property sometime in probably the second quarter of 2016. And we think that the selling price will be weak going forward because of there's plenty amount of unsold inventory from other developers. So if you look at it, third quarter we have 6,000 units, unsold units. Fourth quarter it's 5,800. So net absorption is around 200 units or so each quarter. So meaning that it's not really catching up, or demand is still rather weak. And the second reason why we think that sales will be weak is because of the other developers who are due for QC or qualifying charges this year might actually start to price down some of their units in order to try to move units faster. And just a bit more about this development. It obtained TOP last month, and up to now there's still 87% of the units unsold. And for this development, QC will only come in end 2018, meaning that the group has around 18 months or so to clear the remaining units. And in contrast to High Park Residences, which was the previous development that we talked about, this is a high-end development, means that quantum is a lot higher, and because of the mortgage servicing ratio and the total debt servicing ratio, um, the development is only targeted to those who commands a higher disposable income. Now, just a couple of weeks ago, they they won a land tender at Tanah Merah area. So the bid that they put in was $420 million, translating into a land cost of $761 per square feet. And based on the recent transactions around the area, specifically in this nearby development called Eco, we think that margins for this development when launched should come in around 15 or 18%. And Eco, which is the competing development that has already been sold, 90%, 97% or so. So similar to High Park Residences, we think that they should adopt the same business model, that is to build smaller units, allowing buyers to allowing home buyers with slightly lower disposable income to buy these units because of the slightly more lax financing agreements bound by the TDSR and MSR requirements. Okay, now we go into Australia. They launched this development called Williamson Estate, which is in Melbourne in the Doncaster suburban district. It was launched in 2015 January, but has already been almost completely sold. This is a townhouse kind of development, which is almost equivalent to terraces in Singapore. And our estimates suggest that development margins should be in the area of around 25% or so. And even though land prices are cheaper in Australia, but because of the higher construction costs, margins are somehow comparable to Singapore. And upcoming, there's this particular land site that they have sold in Melbourne, which is in 170 Victoria Street. It was first bought in 2013 at a price of 32 million Australian dollars, but subsequently in last year in March, they were locked into a sales and purchase agreement to sell the land off at 64.8 million, doubling its profits just between just around 2 years or so. Okay, there there's this extension of Williamson Estate. It's actually on the same site area as the previous development I've mentioned, Williamson Estate. These are actually apartment units, 72 apartment units, which we share the same site area of Williamson Estate. So it's actually launched already, despite me saying that it's going to be launched in the first quarter, because from my last check on the website, it's really launched. So we up to now, demand has been pretty soft, and you're looking at 1 or 2 units being sold. And this is because if I just bring everyone's attention to the charts here, even though we see that prices for properties have been appreciating, but if you pay attention to the transaction volume, it has been declining quite drastically. And in general, transaction volume has always been the indicator for property prices. So even if you look at now, bring everyone's attention to 2009, when transaction volume started to fall throughout the whole year in 2009, you see that prices only started to come down in 2010, and it's the same for any other year. So if you look at 2013, 2014, it's the same. So in 2015, even though you see that in 2015, transaction volumes has really fallen quite significantly, but prices still haven't shown it yet. Okay, they have this completely sold project called the Tower Melbourne, but because of some ongoing legal issues, they were not able to proceed with the development, and therefore there were challenges booking in the revenue as well. The last update was that the Victorian Court in Melbourne has really struck off the cancellation application for the development's planning permit. So we acknowledge that there are uncertainties for this development, completion of this development. So in order to stay conservative, we have excluded any development profits to be from Tower Melbourne. So, but if we were to include it, it should add around 5 cents or so to our RNAV projection. Okay, now we'll move on to the construction sector. We think that the environment will continue remaining challenging for at least for the rest of the year, all the way to next year or so. And if you look at their order book, it has shrank to 570.1 million from 622 million compared to, I mean that this was we're looking at a 1 year comparison. And this is mainly due to the lesser number of active projects that the group is engaged in. But going forward, we think that if there are any new projects, the group is well positioned to get them because of the very solid track record that they have. However, um, if you just look at the chart here, the new launches of flats have been coming down very significantly after the government has boosted launches for a 4-year period between 2011 to 2014. So in 2015, 2016, new launches have come down to around 16,000, 18,000 per year. And because of the challenging environment, we are expecting further margin compression. So, and because of the now we and right because of the weak environment in property development, we think that residential construction activities remain lackluster, and this is because of the excess supply of unsold private properties, which we have just talked about just now. And as a result, public project tenders will be increasingly competitive amid this challenging landscape. And lastly, for the construction sector, for its construction arm, the group has reverse plans to spin off its construction segment. Based on the announcement that they have put up in February last month, they quoted that market conditions are challenging now, and therefore they have caught off. But our opinion is that even if they were able to spin it off, the valuations are most likely not attractive, because if you look at the past few years of net asset value of the construction arm, it has been declining consecutively from 2013, $58 million all the way to $37.8 million in 2015. Hospitality is a new segment for Ship Ming Sing. Now, they own this hotel property in Alexandra Park. In Queenstown, called the Alexandra Park Hotel. During the 7 months in 2015, it booked in a revenue of $14.1 million, and this was slightly below our expectations because of the weaker operating statistics due to headwinds in the hospitality sector. But we think that booking a RevPAR of $125 or so based on an occupancy rate of 85% and average daily room rate of $150 is doable, even though there is that corporate leasing or corporate demand is soft. And this is because of the scarcity of hotel facilities within the location. There are only 2 other hotels within the location, and only one of them is targeted at the corporate segment. So there are only 2 corporate hotels within the vicinity. And last year, even though visitors they're coming back to Singapore, but growth rate is still rather slow. For the entire year of 2015, visitor growth was at 0.9%. So compared to 2014, there was a drop in visitor arrivals. So somehow, no, I should say that the visitors are coming back. But the thing about it is that hotel room supply is still growing faster than the amount of visitors are coming in. So the oversupply conditions, the oversupply in rooms will still carry on lasting for a while. And for its investment property segment, CES Center actually came online in first quarter of 2015. It contributed a rental of around $3.2 million, and it works out to be $3.20 per square foot per month. And this is excluding the rental contribution from the top two floors which the group currently occupies. But if we compare the per square foot rental to nearby commercial buildings such as my Manhattan and Tong Chai building, and these are much older establishments which are like at least 15 years or so. So even though they are older, but per square foot rental is around is more than 20% higher. So it suggests that CES Center, which Chip Ming Sing is operating, should experience some positive rental reversion or higher rental reversions going forward. And lastly, we think that they are likely to pursue acquisitions in the overseas market because in Singapore, just in 2016, we are looking at 4.6 million new office units coming on board. And coupled with the uncertainties in the economic environment, we think that rental is likely going to be weaker going forward. Now, there are two catalysts that we would like to see before we do any revision in target price. So the first one would of course be the settlement on the legal issue for Tower Melbourne. So what I'd like to share with everyone is that the construction phase for Tower Melbourne is 48 months because this is a 72-story skyscraper tower. And the next thing to understand is that there is this sunset clause which the development or the home buyers of the development is entitled to. It states that as long as handover of the units is before end 2020, or put this way, if units are not handed over by 2020, the developer would have to refund all the monies which they have collected for this development, plus an administrative cost. So if they are able to, so in a way, as long as they can begin development of the property by end 2017, they will be able to, they will definitely be able to hand over the units. And again, as I've stated just now, the booking of Tower Melbourne's development profit will add around 5 cents or so to our RNAV projection. And just for everyone's info, Tower Melbourne has really been fully sold. And the next potential catalyst that we'd like to see is, of course, the unwinding of property cooling measures in Singapore. So Chip Ming Sing is likely to be a major beneficiary for the unwinding of these cooling measures. And the most obvious one would be that this will be a potential boost to the average selling prices of the two new development projects in Tanah Merah and Fulcrum. So, and the rejuvenation of property investments is likely to fuel the activities in property development, meaning that Chip Heng Seng will have more order book coming onto its hand from construction. And lastly, the recovery in construction sector should be able to lift valuations of the construction arm, rekindling the probability of a spin-off. And finally, we are at its valuations. So based on the net asset value as at 31st December 2015, net asset value is at $743 million, plus the development surplus in Singapore and Australia brings us to a RNAV of $897.5 million, translating into a RNAV per share of $1.44 around that region. But we have applied a 50% discount to RNAV because of the challenging operating environments. So four of these business segments, all four of them have challenges going forward, and we think that applying a 50% discount is justifiable. And this brings us to a target price of 72 cents. And our call is to maintain accumulate, but we have revised our target price downwards to 72 cents. Previously, it was at $1.04. Now, lastly, we should see some visibility of the group sustaining their dividends, because just by booking development profits from High Park residences, we are looking at something like $32 million per year. And this translates into an EPS, safely translates into an EPS of around 4 cents or so, which matches the past 6 years of dividends distribution at 4 cents. This excludes the special dividends which the group pays during the good years. Okay, finally, this is the peer comparison table. If you look at it, we it, it's currently trading at a valuations below its peers. So on average, price to book of the sector of the construction sector is at 0.9 times or so. And for that, I'll pass the remaining time to.
Hi, good morning guys. Hong here. So I'll next go on to touch on another developer. It's called Hobby Land. So Hobby is currently one of the most heavily discounted developer on our local exchange. We are seeing an approximate 53% discount to book currently. And later I'll show you guys a peer comparison table. You see that amongst the peers for those developers with more than $1 billion market cap, Hobby is one of the heaviest discounted. So we will drill down to as to why the market is taking Hobby's portfolio to be in such negative light. So before that, we will first introduce Hobby's latest portfolio. So by gross asset value at the latest quarter, based on our calculations, we see that we look at the blue part portion and the green portion. So Hobby is actually very, very invested in office properties, both in Singapore and in London. So in London, we have 6 office properties. They went into London in a big way since 2013. And then Singapore, they have the Metropolis, which is the largest property in their portfolio by valuation. Metropolis is actually a Grade A office in Buona Vista. The entry into this Finch area office property segment is also another show of the shrewdness of management, which I'll touch on later as well. Then next we move on to this red portion, which is local residential, which I think is the reason for why the company is being perceived in such a negative light currently, because what they're having currently in their portfolio is they're having 3 Sentosa condominiums, okay, Turquoise, Seascape, and Cape Royale. And these 2 of them have TOP'd in 2010, 2011, Cape Royale 2013. So because of the negative sentiment in the high-end residential property sector, the management has decided to lease out all the units. And lastly, we have this overseas residential in Australia and China. I think this portion is the least of my worry, because properties there are selling well. So executional risk in this development portion, I think, is pretty low. So today I will mainly concentrate on the other 3 parts. And then I think for Hobby, we have a few why we think the discount is excessive at the moment, because of a few main reasons. Because firstly, look at office portfolio, which is about 71% of their portfolio GAV, right? These are very stable offices. Metropolis, for instance, is 100% occupied. And over the next 2 years, you're looking at lease expiries which are very minimal. And then London office leases are very long term. Typically, they do like 10-year with reversions every 5 years. So these two portions are already huge in the portfolio, are so stable. So what we have left is this purple portion and this red portion, development portion, which are faced with uncertainties. So first we go on to touch on Singapore's high-end residential segment. So as I mentioned, OB actually has 3 condominiums in their portfolio currently. Turquoise and Seascape IPO'd sometime back after 2010. They sold a few units. After that, sentiment changed because we know that in 2010, that was when the government started to introduce cooling measures. You can see from the median price charts tables at the bottom of the screen as well. You see that post 2010, the year-on-year change for the median price after we started recovering in the first quarter of 09, we shot up. But then post 2010, after all the cooling measures started to come in one by one after another, the growth started to slow down. And I think for high-end residential, there is another headwind in that. Not only are we faced with ABSDs in 2011, 2013, 2012, we also saw this fi- financial investor scheme. That one is actually is this incentive that the government introduced some time back to give foreigners a chance who wants to become PRs in Singapore to expedite their PR application if they move in a $10 million in assets and park them in Singapore for 5 years, and out of which 20% of these assets can be used to buy property. So this scheme used to be a magnet for all the rich people in the region who see Singapore as a stable relocation destination. But then, because after 2011, the big hoo-ha uproar over the huge influx of foreigners, we see the government started to tighten on this influx of these foreigners. So 2012, they removed this financial investor scheme. So meaning to say, investors who wish to come and get PR by just parking money, they think they can get PR by just parking money. That is already impossible. Of course, there are other ways to get PR. You can bring in your company subject to a minimum turnover value, but then the other easier alternative, at least until after 2012, that's gone. So we can see uh, the median price for core central region, actually they picked somewhat in 2011. It went up slightly, and then 2013 everything came down after the TDSR and more ABSDs rolling out. So for back to these three properties, right? Management has not launched Kit Royale, so you can see units unsold is a full quantum. This one IPO, this one TOP'd in 2013 if I remember correctly. But sentiment was bad. So now they decided to temporarily lease out all the units there. And leasing status is as such, 80-80-60. And one thing to note is that now there is a lot of talk about which developer is going to face how much in charges for QC, for ABSD, if they cannot sell the properties within 2 years of TOP. But for OB, it is safe in that Sentosa properties are not subject to QC charges. So they are lucky in the sense that even though they cannot sell, they can still choose to lease them out until sentiment change. So it's unlike all the other developers like Wing Tai, they're stuck with condominiums in Orchard Road. You cannot sell within 2 years, which is why Wing Tai is facing a lot of headwinds now as well, because they have these two condominiums in Orchard which they're facing difficulties selling. So we talked about the median price of properties in the core central region and outside central region, peaking somewhat in 2013. So likewise, all these cooling measures such as the ABSD, the lifting of the FIS. They also have a strong effect in cooling transactions for residential units in the core central region, which is where all the high net worths will be looking to invest in. So you see that post 2010, this is the first round of all the cooling measures, and then 2012 we saw a short recovery, but not to be long-lived, because we saw that after the scheme was abolished, transaction volume went straight down all the way. So right now, we are only looking at every quarter less than 500 units moved in total. In the heyday, we can do as many as up to 4,000 units in a single quarter. So you can see drastically transaction volume has dropped. And I think in times like this where volumes are not very high, a lot of times you tend to get prices which are distorted, which are not reflecting the real worth of what the properties are actually should be worth. So we take a step back, we look at Singapore's high-end property as how attractive a proposition it is to investors and to people, to high net worths who wish to relocate, whether they want to relocate here or they want to see Singapore, they want to buy Singapore properties as investment tools. So I think given the vision that we know that Singapore, we are trying to become this global wealth management hub. We have all these very attractive tax structures. We have stable political systems, very stable economy. So this has been all the while our attractive features to people who wish to relocate. And I think it's not far-fetched to say that given our aim to become this global wealth management hub, the continued drive to try to attract people into the country should continue, even though at a lower pace. So there was this article in the Business Times last year. It's quoted the wealth report done by Knight Frank, and they surveyed the ultra high net worths, and then they found that the top four cities which actually mattered to them is Singapore, Hong Kong, New York, and London. And out of this top four, they also found that they also surveyed and researched that over the 10 years from 2014, the city that is likely to see the highest increase percentage-wise in ultra high net worths is actually Singapore. And if you look at these four cities which are of top interest to ultra high net worths, you see that in Asia is between Singapore and Hong Kong. But for Hong Kong, you look at recent times, you look at the last few years where they had this unrest, the umbrella protest, umbrella movement, the rising anti-Chinese sentiment in the country. I think that will only increase the attractiveness of Singapore versus Hong Kong, at least for Chinese millionaires who wish to relocate out of the country. And another reason why, what could be the reason for this potentially highest increase in ultra high net worths into the country is also because if you look at the prime property pricing for these top cities, the top four cities, you see that actually Singapore is the most attractively priced. We're looking at at least minimum 10% premium if you were to buy in New York instead, or a much higher 80 or 90% premium if you were to go to London or Hong Kong. So we will next go on to talk more in depth about Sentosa Cove properties, because what is facing Hobby now is that the development properties in Singapore is only those three condos which they are stuck with since 2010. And because of the recent transactions for Sentosa properties, which are done at pretty depressed levels, I suspect that has got to do with why market sentiment is currently so bearish towards high-end developers in general, especially for Hobby as well, because Sentosa, the transacted prices are just extremely depressed. You will see in the table later. So we look at the transacted prices for Sentosa Cove condominiums since 2006. That was when the first residential units over in the island started to go on sale. So a bit of history about Sentosa Cove properties. Kobe was one of the first pioneers to head into the tiny island south as well, because in 2003 they were the ones who bidded for land in the area to develop high-end properties. And you see that from the period from 2006 to 2010, there were actually at least four other projects which Hobie has developed in that on that island, which has seen them create extraordinary shareholder value from the properties there. The entrance into Sentosa Cove actually is one of the very shrewd decisions by management, which really they have displayed their visionary sense. Because if you look at property prices from N06 to 2010, Sentosa Cove prices have actually risen the most out of all the other segments, whether you compare it with mass market, even if you compare it with other high-end properties. These properties in Sentosa actually had appreciated the most in terms of pricing. So if you had bought land way back in 2003 when everything was untested, I think they stood to gain a pretty hefty profit from those few years of developments in Sentosa. So we see that recently transactions thin out. You can see the more sparse blue dots over here. Transactions thin out way back in the heyday. They were trading as high as 3,000 plus PSF. Over the last 2 years, we see that most transactions they were actually doing sub 2,000 PSF, right? And for this sub 2,000 PSF includes turquoise and seascape. And turquoise particularly had a few transactions which were done around the 1,500 mark. But previously, when they were at their prime, these properties were actually trading at more than 2,500 PSF. So if you look at the property in Sentosa as a whole, even though if you look at the broad index for mass market, or if you look at the broad index for luxury properties in core regions, right, you see that the index is actually down just 8%, which is why government is calling a lot of people is government is saying that the price drop is not that much yet, so maybe not yet time for relaxing of cooling measures, right? So broad index showing 8%, but actually if you dig further, Sentosa properties have collapsed way heavier than the 8%. We're looking at turquoise, for instance, more than 2,500 to currently 1,500. That is more than 30% drop in prices. So why do I say, or why do I feel like these transactions does not reflect the true value of the properties there? Okay, not to be confused by the anchoring effect, not just because last time they were trading at 2,500 and that's why now it's trading at 1,005 and that's why I'm saying it can go back to the previous high, but also because if you look at what other properties in Singapore they're trading at, so we know that Sentosa, they have been trading below 2,000, right? From 1,005 to 2,000. Okay, some of them are even below 1,005. That's ridiculous. So we take 1,005 to 2,000, right? PSF. We compare with other projects which are done in the last 3 years. Okay, so we take similar projects. This these Sentosa condos are actually huge. They are more than 200 square meters. So that's actually something you cannot is more and more difficult to find in Singapore nowadays, because the trend for developers nowadays is that increasingly they are developing smaller and smaller units. Reason for that is because of improved sellability. Your units are smaller, your PSF you can charge higher, but your quantum amount is still lower. So quantum amount is lower, you can attract potentially a bigger crowd to buy from you. So big units, which I think should appeal to the rich, because if you're that rich, you don't want to be constrained to a small, tiny shoebox, right? So big units like more than 190 square meters. These are the units we are looking at. Okay, and traded from 2013 between 1005 to 2000 PSF. You see locations like Queenstown. You see locations like Bukit Timah. D'Leedon is actually a lot of transactions done for D'Leedon is under Capital Land. This is actually in the Queenstown area as well. You see locations like Bishan and Newton and Marine Parade. While I have no doubt that these are very, very good locations, but I think if you compare them versus Sentosa, given the exclusivity of the properties on that island itself, and then the offer of waterfront living, I think that should command a premium versus the other address. Because I think if you are the ultra rich, what you want is some exclusivity. You want a privacy. You want some exclusive address that you can have. So if we drill down further, we see that you look at Pebble Bay. Pebble Bay and Camelot by the water, they are actually condominiums in Tanjong Rhu, Fort Road area. And these two are actually pretty old properties, 20 years old. TO paid in 1996, 97. So you're looking at 20-year-old condominiums in Tanjong Rhu, trading at prices which are higher than what turquoise has been traded for. I think that is a sign that is either one of them is mispriced in the market, because 20-year-old property in Tanjong Rhu versus turquoise is about maybe eight years old, but definitely less than half the age of these two properties. So I think you are looking at a mispricing there between what the Sentosa properties have to offer and the other addresses. And if you look at the top one, between 1005 to 2000 PSF, you see Marina Bay Suites, and you think, okay, this is a very, very premium location, right? And if this premium location property project can be selling at 2000 PSF, so why is 1005 or 1007 too little to pay for Sentosa properties? Like in their heydays, Sentosa properties were trading at levels which are close to what we saw for Marina Bay Suites. This, I would say, this is a single transaction, which I would say is an outlier, because for Marina Bay Suites, they actually have 29 other transactions done between 2150 and 3003 PSF. And I think given the large transaction size here, it's a better reflection of how much value that buyers are giving to developments in this area. So in their heyday, these Sentosa condos can be doing at this kind of level, but it's just recently because of the negative sentiment. And note that these could be sellers who are actually they are there were that I'm sure you guys must have seen reports on buyers making or sellers making hefty losses on properties that they've sold in Sentosa. So there could be many reasons why they're selling. Could be forced out because of rising interest rates or falling stock markets. So I think this latest transaction prices could be making people paint a more bearish than realistic picture of what the properties in Sentosa actually can command. So we'll next move on to talk about the Singapore office sector. The This is where Hobby Land has the Metropolis. This is a Grade A office in Buona Vista. This uh, this was entered into by Hobby in 2010. Okay, 2010, when they bidded for the land, there were only two bidders. Okay, and at that point in time, Grade A offices in Buona Vista was relatively untested. It's a concept that nobody knew whether it could take off. But like I said, the vision and the foresight of management to bid for the land and to develop this, which actually was a venture that paid out very well for the bid, because the cost price of the all-in cost to develop it, so maybe like 700 plus PSF versus the average passing rents now of $7 per square foot, is actually, you're looking at very, very handsome yields for OB. And for Metropolis now, 100% occupied, they have managed to attract very big name tenants. You have the likes of Procter and Gamble, you have the likes of General Electric, our Central Depository, CDP is there as well. NOL is there as well, Shell is there as well. So I think increasingly we are seeing a lot of corporates move out of centralized office areas into suburban office areas as they seek to cut costs and as the global economy continues to be on unstable footing. So these are some of the more major transactions that has occurred over the last few years. You see a lot of them actually moving from central areas to offices in Pasir Panjang, business parks, in Changi, etc. So this increasing trend of office decentralization actually bodes well for Metropolis and Mobi. And for the Metropolis, because it's a very new property, it's come online only in 2013. We bid for the land 2010, come online 2013. So a very new project. Lease expires over the next 2 years is very, very minimal. So you can expect occupancy to not deviate too much from current levels. Okay, so I would say this is a very stable property that OB has, and this is really the pride of what OB is having now in their portfolio. Is a very is a huge venture that paid off in a very great way for OB. And as we mentioned, because of the trend of this decentralization, the we look at fringe office rents. They have actually held up better since the uh, post GFC. We see the top from the top to current, it's actually dropped about 6% for offices in fringe areas, rental index. But for offices in central area, peak to current is actually down about 11%. So I guess you're seeing that this trend of decentralization is actually helping support the rentals for offices in the fringe area. And next, I'll move on to London office. This is where Hobby has six offices in London, six office buildings in London. So previously, if we track what Hobby has done since post GFC, they have since after 2009, they have not bidded for any land for residential sites in Singapore. But instead, in 2010, they decided to move into office buildings in suburban areas. That is the metropolis we just mentioned. So 2010, that was a big project they had. Then after that, no land tenders for residentials. In 2013, they decided to go into London. London, they have a bit of history in that in 1996, Kobe was also into London for the first time. That was when they developed residential apartments. And actually, if you look at the sterling pound versus the Sing dollar, post 1996, there was actually a big appreciation in the sterling pound versus Sing dollars, and London property prices boomed there as well. So I would say 1996, that decision was actually a very, very good move as well for management. So 2013, back to our office sector where we are talking about. 2013, they re-entered London. They bought their first office property in Rose Court. Currently, office London office prices have already risen about 17% since they first announced a deal to buy the office in May 2013. And then, if you had checked out the news recently, the amount of they're actually trying to put up this Rose Court for sale. The sale price, the asking price is actually already at a close to 50% premium to their entry price. Okay, and I think if you can make that kind of returns in 3 years, you are actually it was a very good move going in there in 2013, a very timely buy. So now we look at I think Sterling there's some weakness recently as well on fears of Brexit. And look at May 2013 when the OB first introduced the post-court purchase. The the pound is actually still at a slightly stronger rate than when they first announced the acquisition in 2013. And then I think the the recent volatility in the sterling pound actually it could create temporary headwinds, but then Hobie is in there. You look at it for the long term in betting that London's importance as a financial hub. I don't think this will change regardless whether Britain is in or out of the European Union. And another thing for Hobie is that because they entered early, so office prices versus when they first entered is already way higher than than when they first entered. So, and then a third thing for them is that because London office leases are very long term, and they have reversions in every 5 years. So because of this long term office leases, you're actually pretty secure. You have your rentals locked in. So short term volatility and headwinds notwithstanding, I think in the long run, as backed up by previous decisions by management, we should be seeing these office properties in London provide good support to the recurring income for Hubi. So next thing I want to talk about is this very why we think big discount to book value should gradually narrow, because in buying this company, you're looking at a management which has displayed strategic vision and very sound decisions in over the years, and in the process grown the company from just a couple of 100 million market cap at listing in 1999 to one that has a market cap of 1.4 billion currently, and 1.4 billion is still trading at less than half the book value. So how has management actually grown shareholder value? You see along the way they made very good decisions. We talked about going into London residential in 1996, right? So that was, if you recall, just 1 year before the Asian financial crisis set in. And let's say, okay, if you had gone into Singapore property, Singapore residential, okay, 1996, that was actually the time where the home pricing index for Singapore hit a peak before the AFC. And post the peak and post AFC, it actually took Singapore close to 10 years, around in 2007, before they recovered to the level seen in 1996. So, because along the way we had several crises, we had Asian financial crisis, we had dot-com bust, we had SARS as well. Then, so the decision to go into London actually enabled them to not only avert the Asian financial crisis, they were able to ride on the boom of the London residential properties as well as the appreciation in the sterling pound. And then secondly, Sentosa Cove, the entry in 2003. That was when the residential properties in the island were still relatively untested as well. So you see management doing decisions like number three is decision which is to venture into something untested as well. Grade A offices in suburban. Right, so Sentosa Cove, the decision actually paid off very well for them as well. 2006 to 2010, like I mentioned, they actually developed a lot of other developments as well, enabled them to make very handsome profits, which is why the share price during that period of time was actually just practically through the roof. Okay, so they saw the potential early, likewise for Grade A offices in Buona Vista, and this time round they're going into London office So since 2009, they have not been involved in Singapore's land price tenders, which is rightly so because we saw after 2010, we saw in the charts earlier on, right, how the markets peaked out in 2011, 2013. If you had bidded for land then, takes you 3 years to complete building. After 3 years later, you come out, probably you have difficulty selling, especially for Hobby when they are a high-end developer, right? So that was actually a good move as well. Uh, so lastly, we look at peer comparison for Hobby then. As mentioned, the discount is one of the biggest. This is listed. This is arranged by a decreasing market cap. One of the biggest discounts. The next biggest you can see will be Wing Tai, but then Wing Tai is a different vehicle altogether. It's facing a lot of QC charges this year because of the Orchard Road condos they have. So Hobby not facing any QC charges. The big portions of their portfolio stable. I think it's an unfair discount that the company is facing. So historically, the average discount is about 33% post GFC. Our target price is based on a almost similar 40% discount to RNAV, and we have a target price of 227. Um, and this is the RNAV table that we will present. So I think with that, I've come to the end of the presentation for this week. It's a bit naggy, it's a bit long this week. Sorry about that. And for now, we'll start to take questions.
Hi, there's a question about gearing on Chip Sing and Hobie. Actually, these statistics are published in our report, so you can just log in into the Phillip Research Portal and you'll be able to see it.
Hey guys, question on Hobby's dividend yield. Hobby's dividend yield currently is about 3.5%. They declared a 7 cents dividend this week, 5 cents 2 year and 2 year, 2 cents special. Going forward, I would think the dividends will be able to be maintained because now they have a very huge portion of their portfolio with recurring income. So I think it's not too big a problem for them to maintain this dividend. So current yield is about 3.5%. Another question on the possibility of privatization. I think you can see from the Bloomberg chart I put up, management has been very, very actively buying. These green boxes actually are buying by Hobby Holdings. Hobby Holdings is 70% owned by Chua Tian-po, the chairman of Hobby. So currently he owns about 73% thereabouts. And there's always market talk of privatization. It can be a potential catalyst, but I think it's not because it's a lot of privatization talk is for if they need to escape hefty charges for QCs, but for Hobby we're not facing that. Because Sentosa there's no QC charges. And then as regards to the 70% the share by management, right, it has always been that case since the IPO. Management has already held a 70% stake, so it while the very active buying could be a sign, but I think it is hard to comment on this in the current moment. There's a question on Hobby's dividend. This table you see is the historical 12-month view. But if you look at the latest results, Hobby has actually declared over the past year 7 cents. 7 cents dividend. Current price $2. So if you work that out, 7 cents over $2, that's a 3.5% dividend yield. And if you expect that to maintain 7 cents, so you're looking at forward yield 3.5%. Okay, guys, if there are no more questions, I guess we'll end it here for now. Thanks for tuning in, and we hope to see you guys again next week.